Hello, guys. Welcome to this episode number 20 of Chasing the Deal. This time, we are going to analyze, we are going to chase the deal in a one of the top markets, or industrial markets of the US, I would say. Maybe some of you may say that this state, it's not, in the last year, it's not like shining like the sun. But I would say California will always be the biggest state on the US, okay? Well, I don't remember if that's the biggest, or if Texas, the biggest one, but at least it's the first economy on the US. So this time we're gonna analyze market on Inland Empire, which is just east of Los Angeles. It's between Los Angeles and Las Vegas, and it's a very important distribution and logistics hub in the West Coast. So let's get into it. Let me show you, for those of you who don't already, who is the first time you see this show, let me show you my star in the show, which is co-star. This is my property intelligence software. I use it every day to read information about the markets, and also to find properties. As you can see here, you can find the markets. You can sell this tag and then look up for some market. I can look up not only industrial, I can look up for office, retail, multifamily, student, and hospitality markets. It has a lot of information. And also it has markets, not only the US. As you can see some information here about Edmonton, Calgary, some cities, some of the top cities of Canada, and also many markets on the UK. To be honest, I've never seen the information on these other countries, but looks like it has a lot of markets and also sub-markets. As you can see here, at least in the US, you can see also sub-markets. You can filter up by markets, or let me see. I don't know why I can't see the sub-markets. Maybe if I just zoom up. Okay. For example, Los Angeles. I usually can see information about the sub-markets. So let me find out what's going on. I don't want you to think I'm lying. Filters. For example, if we look for information in dollars, we should be able to find some information on the sub-markets on Dallas, but I really don't know what's happening right now, because when you try to find some sub-markets here in Dallas, you can find like South Dallas, East Dallas, North Dallas. Oh yeah, here you can see information on sub-markets. You see, you have to sum up first on the market, and then you can see all the sub-markets, so you can see more accurate information on that sub-market. If you are looking for just a property in some part of that market, that will be the way to go. So I don't want you to get bored. So let me show you inland. First I have to select markets, and then I will go to inland empire. So what is inland empire? As you can see, inland empire, it's not a city, but it's more like a cluster, I may say, which is a collection of many cities, like the most important are San Bernardino and Riverside. So you can see, for example, it has many important highways, like the number 10 and the 15 and the 40. So the 40, for example, the 15, for example, goes to Las Vegas, and the number 10 goes to Phoenix, straight to Phoenix. So it's basically a logistics hub for all West Coast, as well as Phoenix and Las Vegas and the Midwest. Okay, so basically you get the products from here, from the port of Long Beach, or from the port of Los Angeles, and you distribute all over the US, all over the West Coast. And also it's cheaper than Los Angeles, because you see, you in Los Angeles, you have mostly inland space. So inland space is, most of the times inland space is more expensive. So you go more to the east, to the inland empire, you will find for sure more less expensive spaces or less expensive land. So let me show you here the information. Okay. So as you can see, let me zoom out. Okay. Maybe, okay. I'm gonna zoom out and then I'm gonna zoom in, because maybe you don't see all the letters here. But I just want to show you these numbers at the top, which are KPIs. What are KPIs? It's the initials for key performance indicators. So basically, key performance indicators are numbers that you can that summarize or give you a first sight, a first picture of the market. So for example, you have here the first number you always have in all markets is the inventory. Inventory always grows up, because it's just the square feet of industrial space you have in this market. So industrial space, it's always growing. At least if you are in a market that it's not shrinking, that it's not tearing down buildings, or it's not demolishing space, you will see most of the times the inventory growing. So for example, here you can see the inventory went up from 782 million. It went up to 794 million. So that was 12 million square feet extra space that was built during the last year or a year ago. It represents 1.5% growth from the last year. So the second number you have is the under construction. Here you can see the first interesting information on this market, because you can see a year ago it was 16.5 million square feet under construction, and then this year it went down to 9.9 million. So that was a drop for 40% down. So that usually means you have an oversupply here. So, or the construction cost grew too much, and the tenants are not paying those rents. because you know, if you are a developer, a real estate developer, you are expecting to get some money from your investment, you know. So if maybe construction costs are very expensive and the tenants are not paying that rent you were calculating to get some valuation or some cap rate, then you simply stop building. You know. So that's what happens here, okay? Because the demand it's not as strong as you may think. So it dropped almost 40%. That's what we see here. It has to be it may be two things, because you know, if you stop building, maybe because the demand is weak, or maybe the offering it's too strong. Maybe the other developers, the competitors start building a lot without thinking too much, you know, and they ended up overbuilding. That's what may happen. Okay. That's why you always have to first. You have to read these reports before investing. You have to read this number. This third KPI, for example, is the net absorption. So that what means net absorption? It means new tenants moving in. It doesn't comes the tenants that move from one space to the other to another in the same markets, because those tenants were already in that market. It only counts new tenants, new space that was being leased up. So that space, most of that space was new. Most of the time, it's new space. But could be the case that it's the vacancy. You are filling the vacancies. So in that case, you can have a positive net absorption without more deliveries, because you are just filling the vacancies. Okay. So what we can see here, it's also a drop in the net absorption. That's a bad thing. That's a bad thing, because that means you are not having new tenants moving in this market. You are not having new tenants. So that's why developers stop building, you know, because you are not having demand, or the demand is shrinking, getting lower. Okay, so the fourth number we have here is the vacancy. The vacancy is how much space is vacant. It's vacant. It's not rented out. Okay, so that means 9% of the inventory it's vacant. Okay, so it also shows that the vacancy went up in 1 year. So from 7.7% to 9%. That was 1.3%. Okay, here. Then you have this the market asking rent per square feet. Usually, if you see the vacancies grow, and you see the net absorption going down, dropping, the third thing you can see dropping, it's the rent, the asking rent. Okay, because when you have a lack of demand, you have to lower the rent prices. Okay, and if you have too much space, too many space vacant, you have to drop the rents. Okay, so that's why you see, not always, it may be cases where you see in some markets you can see vacancy going up, but the rent growing in some cases. But But usually when you see net absorption dropping and the vacancy going up, the third thing you can expect is the rents going down. Okay, so the last thing is the market sale price. As you can see, this is counterintuitive, as I told you, because you see the prices per square foot going up. This is counterintuitive because you have a growing vacancy and you have a dropping net absorption. So the buildings are selling for more. What's happening here? So you may see these kind of things here in these markets. And also because you may see newer spaces, and also maybe the case that this number grows because you have new inventory. So all the inventory are giving you a read or a number, a lower number, because all buildings are lower price. So if you start building new inventory, you can see this number growing up. Okay, so that's what may be happening here. And the last thing, and this is very important, is the cap rate. So at this point, if you watch me, you may already know that a lower cap rate means a more expensive building or more dollars for your investments. Okay, I mean less dollars for your investment, so you have to pay more for the building in order to get some amount of rent or net operating income. So why this market that has dropping net absorption and low and growing vacancies has a low cap rate? So that's also counterintuitive, because in most markets, when you see these numbers dropping and the vacancy going up, you may see a higher cap rate, okay, like 7, 8, like more than national average. But here you see a 5%. So why do I think you see a low cap rate here in California? Where I suppose it's because you have a lot of money. You have a lot of money. So when you have a lot of money and you have a lot of local investors, those investors keep investing whatever money they are taking from that investment, So that's what I have seen this in markets, in other markets like for example Mexico, that are more illiquid markets. So because these markets are more illiquid, and it's maybe the other reason, because California have strictened rules for environmental and some things, and selling those assets can be a headache. Okay, so selling those assets can be a headache because you have to comply with the environmental and many things, and many investors just keep locked in that investment, and they don't sell. So if they don't sell, the price don't drops, so the cap rate stays lower. So that may be one explanation for lower cap rate. The other explanation is that you have a lot of money. So if you have those two things, you have a lot of money and you have that money trapped in that market, you will see a low cap rate. So as I mentioned, in Mexico, for example, it's not easy for the investors, for the local investors in Mexico to sell, because if they sell, they have to pay high taxes. Okay, so they stay in that investment maybe 20 years, maybe all the lives. Okay, So that takes those cap rates to the lower numbers. For example, in big cities in Mexico, I'm talking about, for example, single family. You can see cap rates of 3%. That's unreasonable, because here in the US, at least for single family, I think the numbers are like 5-6% cap rate, but they are US dollars. Those are US dollars. So you might expect that the cap rates in Mexico for single families will be above the cap rates for single families in the US, but that's not the case. Okay, that's not the case, because the investors are locked in with that money all their life. So they don't sell. They don't drop the price. They prefer to stay all their life in the investment than dropping the prices. So that may be an explanation for the lower cap rates here in California. Okay, so let me show you some more numbers here. As you see, with these KPIs, these are just 6 numbers. With those 6 numbers, you can understand maybe 70% of the market. Okay, you can understand 70% of the market. Maybe you can invest with that information, but CoStar gives you more information. For example, here you can compare the markets, this market number with the national numbers. For example, the market asking rent here, it's $12 with 11 cents, but the national it's $12 with 16 cents. Okay, so it's pretty similar. Pretty similar with the national, in line with the national. Vacancies here at 9%, and the national is 7.6%. This is useful if you want to know if this market is just in the line with the nationals numbers, or it's a market that it's going down because local features, local characteristics, or it's going up because something is happening there. So you can see here, for example, the vacancy, it's pretty similar, not the same, but pretty similar with the national. But it's higher. Why is higher? Why the vacancies went up? I've told you before that the vacancies in all the US industrial markets went up because of the tariffs. Most of it is because of the tariffs. So if you see this market that is very close to a port, and that port, most of the trade comes from China, that's the answer. You have the answer there, okay? Because the tariffs, most of the tariffs were applied to China. Okay, so vacant, you can see the vacancies here. Availability rate. Availability, it's a little bit higher than the vacancy. It's kind of similar, kind of the same thing. But vacancy, it's just the space that it's already built. It's already built and it's vacant. It's not leased and it's available. But availability may be some space that you have rented out, but it's not vacant. A tenant is inside. But once the lease expires, the tenant will not renew the lease. So you start to trying to rent out. Okay, so that space is available. It's not vacant because a tenant it's inside, but it's available because you are listing in the market. And also available space, this number is higher because some tenants may have rights to sublease. For example, let's say you have a big tenant like Amazon, and this tenant has a 1 million square feet building, industrial building, but then they realize because their numbers, their revenue decreased, they now only need half of that space. So they decide to rent out half million or 500,000 square feet. So that 500,000 square feet is available space. It's not vacant because Amazon it's inside, but they are offering to the market. So that's why these numbers comes bigger than the vacancy. Okay. So net absorption, you can see here. I'm a little bit sick. Leasing probability in 6 months. This is useful if you are going to invest in a vacant space. Okay. For example, an owner-occupied property that you are going to purchase, and once you purchase, the tenant will move out. Then you want to know how long would you take in that market to rent it out. So the probability in 6 months to rent it out is 50%. Okay, so that means you have 1 or 2 possibilities to rent it out in 6 months. Okay, and also you have another number that it's the average leasing time. Okay, so existing buildings, inventory. So you can see here some bars, some graphs of the numbers, 9% along the time. Okay, so for example, in 2023, in the first quarter of 2023, you have the lower vacancies. This is for a 10 years timeline. So the lower vacancies were in 2023, in the first quarter, you had 3%. So just 3 years after, it went to 9%. So we are right now at the highest, at the top of the vacancies on 10 years. Okay, so here this is useful if you want to just compare how is this market behaving compared with other times. Net absorption, same way, it's on the lowest. You can see, for example, here the highest was on 2021 during the pandemic. Okay, you see, if you remember that that's where you saw the highest numbers of absorption. Okay, market cap rate, you can see the market cap. You can see, for example, here that the cap rate, it's not like a temporary thing. You can see cap rates here are historically low, which strengthens my hypothesis, okay? Because you have the money trapped here. You have the money trapped here. Those investors, they don't sell. They don't sell to go buy in Texas or other markets, okay? So they have lower cap rates. Okay. Leasing. For example, here you can see some opinions of CoStar people for this report or research about the leasing availability in mid to large size buildings has soared due to pressures from downsizing tenants and speculative development. Availability is the highest among buildings 250 to 500,000 square feet. Okay, which ranks at 18%. Okay, so the vacancy average for all the market 9%, but for these buildings 18%. Okay, followed by 500 to 1 million square feet buildings from 100,000 to 250,000 square feet, which is around 15%. Okay. Meanwhile, availability among smaller buildings from 50 to 100 trends below 11%, and buildings smaller remain stronger in demand. Okay, you always see this kind of trend. The smaller the building, the smaller the vacancy or the availability, because you have more small businesses. You have more small businesses, and usually these small businesses are old, and they are cheaper because they are old. Okay, so small buildings, and also if you go to these big spaces, 250 to 500,000 square feet, even if they are multi-tenant buildings, they don't rent to small companies because they don't want risk. Most of these buildings, if they divide the space, they divide it in maybe 50,000 to 100,000 square feet. They want to rent to divide it the biggest space they can. Okay, because otherwise, if they reduce the space, they reduce the quality of the tenant. Okay, so that's why they do that. Net absorption, and also if you have low quality tenants, maybe that your rents may be higher, which is the case on the flex spaces or those kind of spaces, but maybe your lease terms will be smaller. Okay, maybe you have 1 to 3 year terms, and in these big spaces you may have 5, 7, or 10 years, maybe, or more, if this is a build to suit. Okay, so it's better for them to just let it big as is. Net absorption, you can see, for example, here the net absorption. For example, you can see this yellow line. This green line is the vacancy on the market. You can see it will drop according to this forecast from CoStar. We are, or at least on the second quarter of this year, we will be on the top, on the high, on the peak of the vacancies, and then we will start seeing a drop on the vacancies. Okay, for example, at the end of 2013, we will see a 6.8% vacancy, lower than the national vacancies. Okay, so we can start to pencil out on a strategy here. Okay, let me tell you guys, I don't want you to get bored with this report. Since we are in a market that it's since you see here the numbers of construction dropping, net absorption dropping, but you will see the vacancies dropping in the next years, and also all this money is trapped here. You will not see like the cap rate expanding, okay? Because you can see here in this timeline that the vacancy, that the cap rates are very stable, are between 4.3 and 5, okay? So you will not see like a big expansion of the cap rate. So, and also you will see the rents growing up because the vacancy will drop. You can expect, because the vacancy will drop, you can expect the rents going up. So what I will do here, I will not risk to develop new space. Okay, I don't want to be a contrarian here, at least on the real estate. Maybe I'm a contrarian in the long term, but in some markets, but in this market, I will just do what everyone else is doing. Okay, so if you have the absorption dropping and the under construction dropping, I will not develop here. I will not build new space here. What I will do is I will purchase that new space that it's still vacant, that big space with credit tenants, and I will just hold it. I will just hold it for maybe 7 or 5 years at least 5 years, but more 7 to 10 years. I just leave it that way, and I just leave the rents grow. Leave the rents grow. If the cap rate stays the same, stays stable, you will see the property value grow. Because if you see the rents growing, remember, when you have you have two ways for the value of your property to grow. If the cap rates shrink or go lower, or if the rents grow, okay, whatever those things, if those things happens, you will see the value of your property grow. So if the cap rate stays the same, but the rents grow, you will see the property value grow. So in this market, I'm pretty sure you will see the rents grow, because the report says the vacancy will drop, and also you can see the historically the inflation makes the rents grow. Okay, the inflation makes the rent grow, and if you don't have other developers building more space and making the rents to drop because you have more offering, then you may expect the rent to grow. So in this market, and also because of the tariffs, it will help us to see the rents growing. Because if the products these companies are either manufacturing or distributing in those industrial spaces, in those logistics spaces, if that product, for example, an iPhone, if an iPhone goes from, I don't know how much costs an iPhone, but let's say $2,000. If an iPhone costs $2,000 now, with the tariffs and all these tariffs with China, how much do you expect that same iPhone will cost in 5 years? 3,000 maybe? So if Apple or these companies sell these products for more, they can pay more rent, okay? They can pay more rent. And that's the same thing with all the other companies. So you can expect the rents to grow because the tariffs with China. So in this market, I will just choose a core strategy. That's you purchase a new building and you just, a new cash flowing building, okay? You don't want a vacant building. You purchase a cash flowing building and then just leave it as it, and you sell it in 7 to 10 years and you will make some profit, okay? And if you do it the right way, with the right amount of leverage, you can profit more. Remember, the leverage is like the I don't know what to say, like a big pill to make money, like the magic pill to make money here in the real estate. So that's what I would do. I would purchase some property with a loan, with the mortgage leverage. So let me try to find a property here. As I told you, let me try. So as you can see, you cannot only find market information here, but also for sale properties, for lease, and also properties that are off market. So we are going, well, we can find those properties in this tab. You just click these properties and then you choose here for sale properties. But I usually prefer to just click this one. You can also do the same thing here in the sales, and then you go inland Empire, and then you click for sale. I don't like this thing about Costa that every time you click a new tab, it goes to Austin because they have their headquarters in Austin. I don't know when. If someone from Costa is watching me, please change that. Okay, inland Empire. Okay, and then you can see here for sale properties. You can see here many properties: office, industrial, retail, flex, multifamily, student land, hospitality, healthcare, specialty. But this time we are going to look for industrial, and as you remember, in the report says that the vacancies are lower in the 100 to 250. We don't want to go under 100 because the quality of our tenants will be lower. But if we go over 250, then the vacancy will be higher, and maybe it's not as easy to find tenants. Okay, so we will filter up here industrial filters. Let me filter for space. Property size, we want to go from 100 to 250. 250,000. Okay, so that's where we go. That's what we can see. And also, since we want a cash flowing property, okay, you can see here we have 43 for sale records here in this window. So we just want existing properties, okay? So we stay with 22 properties, but we also want a cash flowing properties. So here you have this filter here for sale type. So it has owner, user, or investment. Owner, user usually means that the property has a company inside, and once you buy that company, they will move out. Investment usually means a cash flowing. I say a cash flowing property. I say usually because some real estate agent, they don't list their properties accordingly. They may have an owner user property and they just check the investment box. Okay, but we can see if it's an investment or a owner user. So we stay with 14 properties, okay? But we want to be close to the highway, and we want to be close to the Long Beach terminal, okay? So I would say maybe these are more expensive, these three on the west, but are closer to the port and are just on the 10 highway. So I'm gonna select this one. What do you think? I'm gonna select this one in Ontario, California, which is well, this is not a new building. I will not select this. Let me filter up a little bit more. I want new properties. So what do I do to filter up new properties? Let me write G-build. So let's say 2023. It was built on 2023 and over. So we have 4 records here. Well, let's say 2020. Just to have more properties to choose from. 2020. 2020 is already new. Oh, we have the same 4 properties. So it looks like we don't have, these developers are very afraid to build new space. Okay? So probably they are expensive. Okay. So we have this one. This one, it's built on 2024. Let me sell this. It's a little bit more far, but it's in a highway, so we don't have problems, because if talking about these properties, we are talking about distribution. We are not talking about last mile distribution, but more like distribution center. Okay, so it doesn't mind if it's very close to the city. So I'm going to select this one. Then we have this one, Coyote Bosch. Price not disclosed. Okay, I'm gonna sell this one, and actually it says 4 properties, but I only see 3. Oh yeah, here I have 2. Okay, this one. I don't know why. I already select this one. What the hell is happening? Okay. One selected, and this one also I want to select. 2 selected, and this one. I don't like this one. It looks like an office building. No, it's an industrial building. Yeah. Okay, I'm gonna select this. What the hell? I had 3 selected. What happens with the third one? I think was this one. Okay, so I'm going to remove unselected. Okay, so we end up with these 3 properties. Only one has the price disclosed. So we have, what I'm gonna do is I'm gonna open a poll, so you can vote for the one you want me to analyze or want me to find more details on. So we have this one. The first option is Barton Street, which it's a brand new building. It was built in 2025. It's 200,000 square feet. Then second option, it's, I don't know how to pronounce it. It's Cedars Road. It was built in 2024. This one has the price almost 45 million for the whole building, which is 195 per square feet. And last one is the Coyote Bosch, which is 144,000 and was built in 2024. So which one? I'm gonna open a poll right now, and you can vote. If you're watching me on YouTube, you can vote on YouTube. Just write the street of the property, so we can count the votes and choose the winner. So again, if you're watching in YouTube, you can vote. If you're watching in LinkedIn, you can write, and also in Facebook. If you are watching me on Facebook, you can write your opinion or your option you want me to choose. So, so Barton, number 1, Cedars Road, number 3, and Bush Road, the number 4. Well, excuse me, number 3, number 2, and number 3. Okay. Okay. Okay, so again, we have the Barton option number 1, the Barton Street. It was built in 2025. It's 200,000 square feet. Let me see. Clear height 36 feet, 34 docks, and 2 drive-ins. Okay. And then we have the Cedars Road. Was built in 2024. Okay. 2024, clear height 36 feet and docks 52. Okay. And finally, we have the Coyote Bush, and built in 2024, 144,000. Clear height 36, 28 exterior docks. Okay, so I think we have a winner here. So we're going to choose the Cedars Road, which is the one that has actually the price. So we have a pretty idea of how much, if the price is right, if it's overpriced, because the average price was 250. But we are gonna make a quick calculation here with the cap rates. They are asking 44.84 million. So you can see here, looks pretty good. You can see these kind of big buildings usually has some office space, but that office space share of the whole building, it's not as big as in the flex build spaces. Okay, because this is more like for logistics or maybe manufacturing. You see, you can have many racks here. Looks pretty good, pretty decent. Okay. Let me read the flyer. I'm gonna show you the flyer. Let me show you the flyer, guys. Replace document. Okay, you may see the flyer now. Okay, the flyer is the document that the listing agent uploads. Okay, here in the commercial we don't have an MLS. We don't have an MLS. It's not like in residential. So usually these agents use proprietary software like CoStar or LoopNet, uh, which is the same company. It's owned by CoStar, or maybe other websites like Vacancy. So they upload these documents on those websites. So we can see only here information about the building, but we cannot see here any financial information. You can see, for example, here the pallets, how many pallets you can store there. So I guess it's more built for logistics than manufacturing. So the difference, when you are purchasing a manufacturing building, like it's more important. Like for example, the floors has to be they has to be capable to support big machinery. Okay, but most of the things are just the same. Usually, many manufacturing they have more drives in. Okay, so let me show you again the CoStar. Okay, so we don't see any financial information here. So that's what I told you. Many of these agents they say it's an investment property, but it's not leased out. So it is probably vacant. I don't know. Let me see if I see something here about the leases. I'm trying to find what's the share here. I think it's vacant, guys. I think it's vacant. Yeah, if you see this number, 229 square feet available, that means it's vacant. It's just vacant. So you see a higher number in the report for the price per square feet. It was around 250, I guess. I remember. But here, if you have a vacant property, the cap rate goes a little bit up, or much. So if the cap rate is 5%, you should offer a cap of 6%. Okay, because it's vacant, and you are going to you have to pay. You have to risk first, and you have to pay. You have to pay the loan for the first months until you find a tenant, unless you get some kind of agreement. As I always say, everything is negotiable. So you can maybe reach some kind of agreement with the seller that he seller financing. You can get seller financing from the seller, maybe 1 year, and you accumulate how seller financing usually works, it's you only pay the interest. You only pay the interest and you pay a balloon payment at the end of the lease. But what you can, since this property is vacant, what I would do is try to negotiate something with the seller, a seller financing for 1 year until I find the tenant. But I would ask him to pay the interest at the end of the year. Okay, so I don't need money to pay for the interest. I don't need investors or my own money to pay for the interest while I find the tenant. Okay, so that's one thing you can do here. Okay, so let's see the financials, the analytics. Let's see the analytics for this market. Asking rent 10. I don't think this is 10. I think at least it's 15 per square feet. Okay. Okay. So let's say we have a 15 per square feet. Let me see the financials. Okay, so let's say I'm just gonna do a fast number here. So we are going to take the rents for 15. These are triple net already, so most of it will be net operating income because they sell the tenant pays for all the expenses. Okay, so if we go, if we just go, let me 15 per square feet and then times the total space, which is 229,934, but then we have 3.45 million a year. Okay, so I'm gonna give this one a 6.2 cap rate because it's vacant. Okay, so divided .062, it goes to $55 million. Okay, 55, even with a cap rate of 6.2, which, remember, according to the market report, the cap rates are from 5 to 6. So I give this one a 6.2 cap rate because it's vacant. Okay, so if we take this market rent on 15 per square feet, we get a value of $55 million. So they are asking $45 million. So of course, this is just a fast calculation. You don't have to make an offer with these kind of things. But relying on this number, on this fast calculation, and also relying on this number, which is the price per square feet, which is below the market, I would say this is a deal to analyze. I would say this is priced correctly, but I would negotiate with the seller for some kind of seller financing because I don't want to risk with a vacant space, especially if it's that big. Okay, so if the seller give me some kind of seller financing and I can pay, where I can pay maybe a low interest, let's say maybe a 5% interest or 6% interest, but I pay at the end of the at the end of the term of the lease as a balloon payment, then I may go with this deal, okay? But I would prefer here in California something that it's already cash flowing, because you see here let me see how days on the market. I'm trying to find the days. It's been on the market for more than 1 year, and it's not leased even the half of it. Okay, so it's definitely not 1 year. It's not enough to lease it. Okay, or maybe they are asking for a high rent. I don't know, but I would prefer here in California a cash flowing property. Okay, but this one, the price, I think it's worth to analyze. So that's all the episode for today. What do you think about this market? What do you think about this strategy, the core strategy? It's not like the most risky strategy. It's not like the one that will make you the most of money. But I think for California, if you go for a cash flowing property and you just leave it like 7 to 10 years, I think at the end of the investment you will make some money, and you will make more than the inflation, of course. Especially if you get financing, if you get leverage. And in California, there are many institutions or lenders available to lend you. Okay, there are many money trapped in California. So what do you think about this strategy? What do you think about this property? Would you go to it to analyze, or maybe you pass? What do you think? Write in the comments. So also, if you want to follow me, you can please subscribe to my channels. I'm on LinkedIn as the Nearshoring team. You can search the Nearshoring team and follow my page, or you can follow me. You can find me as Andres Vite. Also on YouTube, I'm as the Nearshoring team. You just search for the Nearshoring team, and I will be the first one I will show. And also in Facebook, you can find me as the Nearshoring team. So subscribe, give me a like, and also if you want me to help you to purchase a property, an industrial property all over the U.S., I can help you with that. I am a commercial real estate agent with eXp Commercial. We are the largest brokerage in the U.S. by the number of agents and number of transactions. You probably already heard about eXp on the residential side, but we also are in the commercial side. So you can go to my webpage, or you can click on the description and you can contact me if you want to purchase something. My webpage is thenearshoringguide.com. Okay, or you can just go to LinkedIn and you can fill out the contact form. So thank you for watching this live, guys, and see you on the next one. Thank you and bye.